Okay, guys, today we have to discuss the differences that what or the differences between financial accounting, financial reporting, cost account. So first we have to understand that what is financial accounting, and then we will just split this definition and we'll break it down to explain each and every term. The first thing is financial accounting is a systematic recording. The term systematic recording, reporting and analysis of the financial transaction of a business. The focus is on the recording of historical data. This is the definition, and we will now explain what is mean by systematic recording, reporting analysis of the financial transaction. Okay, so here is it. From a financial accounting perspective, systematic recording, reporting, and analysis form a structured sequence to ensure the accurate financial data management, compliance, and decision making. So, if I start from here, that financial accounting is a systematic recording. The second thing is reporting, and the third thing is analysis of work of the financial transaction. Now we will explain that what we mean by systematic recording. So systematic recording is actually the process of carefully documenting every financial transaction. Okay, this means that if you have sale or expenses, then that should be recorded in organized way. Okay, so process of careful documenting every financial transaction, like you may say like sales, expenses, and that should be an organized way. And for that you have to follow the accounting rules, and you know that what are the rules, like you have IFRS, you have GAAP, and these rules you have to apply. Now the other thing you have, why you need to record a transaction in a systematic way. The purpose is just simple, to ensure that all the money moments are tracked accurately. For example, let's say we have a small coffee shop, and the small coffee shop have a transaction. Let's say the transaction happened and 18 April 2025, and the transaction is sales of coffee, and that, let's say, the amount I will write here $300. Okay, now, and the customer paid in cash. Now what will be the systematic recording? The systematic recording is that the coffee shop received $300 in cash from sales, and this is recorded in accounting system like general, or you may use software like QuickBook or PH3 or other software. Okay, fine. And there you have to debit cash because you are received cash, and credit will be your sale revenue. And the amount I have written here is $300. Clear? Now this is about the systematic recording. Now let's move on. We have explained the concept of reporting, that what we mean by reporting. So at the end of the period, it may be year, it may be month or quarter. Okay, and that you mean a coffee shop. I'll write here a coffee shop. Coffee shop will have to prepare income statement. Okay, and that income statement will include $300 of sales, and that is of coffee. Okay, and there may be some other transaction, and that income statement. Fine. Okay, so the report will be like here. Let me write here. The report will be, this is the report. So in the report you will have total revenue, total expenses, and net income. Fine. So the total revenue I have written is $300, and I assume here that the expenses at, let's say, $200. So the net income will be $100. Fine. So this report gives a clear snapshot of the shop earning and cost. Fine. And this is useful for the owners or the investor. Now let's move on. We have to discuss the concept of the analysis. That what we mean by analysis. Go on here. Here, let me write here analysis. This is the third important point in this definition, and that is analysis. So by analysis, we means that reviewing the financial reports that is about say revenue, expenses, and net incomes. That the management will review that financial reports. Let me write here. Reviewing the financial report. Okay. And why we are reviewing? Because to understand the business performance, and based on that we have to make a decision. Clear? Now the owner review the income statement and see that the net income is how much? $100, with expense being 66.7%. If you see here, this is the 200 divided by 3. So the expense being 66.7% of the revenue. Fine. Now inside here is the profit margin is low because expenses are high relative to the sale. So the decision here will be that the owner decide to reduce the cost by finding cheaper supply. They will move. The decision will be here. They will move to the cheaper supply. Or another option this coffee shop owner has, that actually increase the sale, and for that they have to their different strategy that they may increase their sale by introducing or offering let's say new drink, and that drink should be special to boost their earning or income or revenue. So we have understand the three component. The first component in this definition is systematic recording. That about is recording the thing in a way the rules give the guidance about. And then systematic after systematic recording, we have discussed the reporting, that you have to report all the transaction, and that will give the clear snapshot of the earning and cost that is useful for the investor. And then we have discussed the analysis, that is you reviewing the financial reports to understand the business performance, and based on that you have to make decision. Okay, fine. So we have understand that we have clear with an example that systematic recording is the process of carefully documented every financial transaction. Then we have discussed reporting, that aggregating record transaction into structured financial report, and that is your balance sheet, income statement, or cash flow statement. And that is for the shareholder or stakeholder, that may be management, that may be investor, regulators. And then we have discussed the third components, and that is the analysis. By analysis, we mean that interpreting the financial reports to identify trends, assess profitability, liquidity or solvency, and guides strategic decision. Now, at the end, I will say that financial, that is the definition we have discussed. Now, let's move on. What is financial accounting is? So, financial accounting is about to record, record and reports fast financial transaction. So, you have to remember this for your, if you want to differentiate the financial accounting with other types of accounting. Clear? The second point here is that financial accounting create a financial statement, and that will be your balance sheet, your income statement. Okay, and financial accounting is basically used by the external parties, because the balance sheet is for external users, for example your investors and regulators. Then financial accounting is you must have follow official rules and standards, and there is GAAP and IFRS. Clear? And the last point here is that financial accounting reports are typically prepared annually or quarterly. Okay, so this is all about financial accounting. Let's move on to the another type of accounting. Okay, so financial reporting is financial focusing on producing the financial statement for publication outside of the business. Now, the financial statement must comply with applicable, means this output must be comply with applicable accounting standard and regulation to ensure consistency with other businesses and make them more accessible. Let's explain these things, that what we mean by the financial reporting and what is the difference between the financial the reporting and the financial accounting and the financial reporting. So first you have to understand, okay, let me write here. Now we have to discuss the financial reporting. Okay, so financial reporting, we have discussed that this is actually the process of summarizing and presenting recorded financial transaction, and that should be in structure report. Clear? And that will be your income statement, your balance sheet, cash flow. Okay, and these statements will show the performance and the performance and the position of the business. So that will show a business financial performance and position. Now, if you have uh, understand from the previous concept that we have studied, that was let me show you first, and then we will differentiate between these two, that what is the difference between, because they are used interchangeably and there is a slight difference. Let me show you first. If you see here, we have this study here in the report. You see here, and let me show you. Okay, here in this report we have discussed the data is structured in a form that is, coffee shop repair income statement, and that is this one income statement. So what is the difference between this reporting and this reporting? What actually I'm trying to say is that what is the difference between the term reporting that we have studied in the financial accounting definition, and what is the concept behind this financial reporting. So, what is the difference between these two terms? You may have, if you looking from the broader perspective, then these two terms are same and they are used interchangeable. But there is a slight differences between these two. First, I will explain this one, and after that, I will explain the financial reporting. Clear? Here. So here, if you see, I will here. This is the reporting that we have studied in the financial accounting definition. This reporting is basically focused on internal mechanics of filing financial data, and that is from recorded transactions into summarized report. Clear? And these report is for various purposes, mean that they are used, these report, for various purposes. So means that this reporting is for various purposes, and the various purposes I'll write here. The various purposes can include both formal. By formal we means that formal financial statement and informal internal report. For example, management report, budget, etc. So this reporting that we have studied in the financial accounting definition, that is used for various purposes. And the various purposes may be formal purposes, that is for the external financial reporting, and informal purpose means these reporting can be used for the management reports, budget, and etc. Clear? Now, on the other hand, we have financial reporting. Now, this is slightly different from this sort of reporting, and this is the formal, and you may say standardized process of preparing and presenting financial information primarily for external stakeholders like investors, regulators, creditors, and many other like this. Now, here if you see this is actually the purpose here is only focusing the external user or stakeholder, but here there are various purposes and that can be used for various purposes. So this is the first difference, the slight difference between the reporting and financial accounting and before real financial reporting. Now, the second part here is that financial reporting is actually a focus on structured, regulated outputs, and that is your balance sheet, your income statement, your cash flow, right? And they comply with the accounting standard like IFRS GAAP. Now, the third part you have here is that this financial reporting is emphasize external communication, but that one is both for internal and for external. So, and here the compliance with legal or regulatory requirement. So this means that the financial reporting emphasizes on external communication and compliance with the legal or regulatory requirement. So in short, if I summarize the financial, because we are studying this financial reporting, so if I write here that financial reporting is actually a formal process. By formal process, we mean that this is preparing and presenting standardized financial information for external users. So preparing and presenting standardized financial information, let me write here, that is a formal process, which means that preparing and presenting standardized financial information for external user, or you may say stakeholders. The second point is that this will produce a structured output. By structured output, we means that it will produce the financial statement. Financial statement, that is your income statement, your balance sheet. Okay. The third point here is that it is for external user. Financial reporting is for external user. This means that designed for the external user, which means that it is for the investors, regulators, creditors, and others like government and other outside parties. If you think from the compliance perspective, then financial reporting adhere the account to the accounting standard, and that is IFRS and you gave US GAAP. Fine. So, and this is why they have to adhere to the accounting standard, because for the accuracy and consistency, right? Now, you have here that actually this is a summarized data, which means that let's compile the recorded transaction and to clear regulated report, and if you think about the production in the periodic, so this is actually typically issued quarterly, or you may say annually, and that is for external use. Clear? And the purpose of financial reporting is that to communicate the financial health and performance. uh, and why? Because to support why we communicate financial health and performance, because we need to support decision making. By whom? By external party. So mean when the external party want to take decision, and for that reason the financial reporting is very very important. If we communicate the business financial health and performance with those stakeholders, external parties, then they will take a wise decision that whether they have to invest or not in the company. So this one we have done, and the next concept is cost accounting. So let's start the cost accounting. That what is cost accounting? So cost accounting focus on identifying cost, mean a monetary valuation of assessment of resources and their allocation to products, services, inventory, or other item. So this gives businesses information about how much it does cost to provide a particular goods or service. As with the management accounting, the information produced is used inside the organization. So let's elaborate the concept of cost accounting. Wait a minute. So cost accounting is focuses on tracking. Let me write here. Focuses on tracking, analyzing, and managing the cost associated with producing goods or services in a business. So it's basically cost account is actually tracking, analyzing, and then managing the cost that is associated with the production of goods or services in a business. Right now, why we are doing this? Because it helps businesses to understand how much it costs to operate, make product, or deliver services. Clear? And this will enable the better pricing, definitely budgeting, and ultimately cost control. For example, we have already started example, and that was a coffee shop. Let's this coffee shop you want to understand the cost of making one latte, or making one latte to set up profitable selling prices. So how they will track the cost? First, let me write here. It will be more good for us. So the first thing they will do is cost tracking. In this cost tracking, they will have here is a direct cost. For example, this coffee beans, let's say have 0.550 per latte. Here we have milk, and that is, let's say, 0.30 per latte. Okay, this is your direct cost. Now let's move on to the indirect cost. That will be your overhead. We call that overhead. Indirect cost mean overhead, and then you'll have a rent and definitely some utilities allocated per lot. Clear? And I assume here that this will be in monetary term, let's say $0.20. Clear? And there will be some wages allocated per latte, and let's assume that is $0.50. Clear? So the total cost will be, if you add up these all, 50 plus 30 plus 20 and plus 0.50. So if you add up, then it will be $1.50. Clear? So this is your total cost. Now the second step is your cost account application. The second step is cost accounting application. Okay, and this the coffee shop uses this data, and why they are using, because to set the selling price. For example, that is, let's say $4 per lot, and that will be to cover the cost and on profit, right? Now you have to identify the high cost area. Identify the high cost area. For example, let's say we have, if the milk's prices increase or rise, then you have to negotiate with the suppliers, or you may change the supplier where the quality is not compromised. Then you have to plan, budget for monthly ingredient purchases. Clear? Now if you are confused with the word latte, that is a drink of coffee made from, let's say, from the coffee bean espresso and steam milk internally topped with a foam, so that is called latte. Okay, now after doing this, this is your cost accounting. Clear? So this is all about cost accounting, and how the cost accounting is, and for what reason we are concerned with the cost accounting. So we have clearly understand that cost accounting is basically track and analyze the cost of producing goods and services, and help the manager definitely to understand where money is being spent. If you want me to write here, okay, let me write here. The first thing is tracking and analyzing the cost, and the cost of producing definitely goods or services. The second point is it helps the manager to understand that where the money is being spent. Fine. Then it's also used internally, and that if they're using internally, this means that help improve efficiency. And definitely, if you know about the cost, then you have to reduce the cost if it's high. It also focusing on detail like material, your labor, and overhead expenses. Clear? Now let's move on to the next type, that is your management accounting. Here, this is the management accounting. Management accounting focuses on providing information for internal use by manager to help the organization operate more effectively, and the focus in how the fast the focus is on both past and future data information. The information may be commercially sensitive and not made available to external parties. Okay, let me explain this concept, and that will be our last concept regarding this topic, that is the differences between different types of accounting. So if I write here the management accounting, so the management accounting is focuses on providing financial and non-financial information to internal management. And why they are providing this? For planning, decision making, and controlling the business operation. So that's all about management account. Now we have studied that this is provides data for internal internal decision. For example, budgeting. For example, pricing, when they are trying to set the pricing or checking the pricing, this whole thing. Performance evaluation. So the management accounting is providing data for budgeting, pricing, and performance evaluation. Okay, it includes both financial and non-financial. Clear? By financial, we means that it provides data about cost, revenue, and non-financial, we means that customer satisfaction, right? Production efficiencies. Clear? These information is non-financial information, and the management accounting providing those information. Now, it's forward-looking approaches here. That management accounting is a wait a minute. Let me scroll it down. Is a forward-looking. Forward-looking. Definitely, they will be focusing on forecast. They will focusing on budget, and you may say like strategies. Clear? It's not like financial accounting that is looking to the historical data, or the focus is completely on historical information. Okay, the one thing with management accounting is that it is not regulated like that of the financial accounting by the standards, and the standard we mean IFRS or GAAP. Okay, so means there is flexibility in reporting format. Uh, and you may also say that it will, the management accounting support, or you may say help the managers in achieving, their business goals, not personal goals, but business goals, through different types of tools, and the tools maybe variances analysis, cost, volume, profit analysis. There are different type of tools and budgeting. Clear? Now we have to elaborate this management accounting with example. That example we have previously discussed. Let's continue from the previous example. Let's say a coffee shop one. Now the coffee shop we are working on an example that is a coffee shop, and now this coffee shop want to introduce a new iced coffee drink, right? And want to improve the profitability. So what they will do, the management accounting process will be like this. Let me write in management accounting process. The first thing is data collection. And the data collection will be the financial data and non-financial data. So financial data, let's say, cost to make one ice coffee. Let's say we are assuming this is from the cost account. The data will get from the cost accounting. In monetary, all right, this is $1.2, and this will include your, let's say, beans, there may be milk, and coffee. So this is the cost of this financial data we are collecting from the cost accounting, and the cost of making one ice coffee. Right now, the non-financial data will be that the customer survey, and the customer, let me write here, the customer survey shows what? That 70% of customer prefer iced drink, especially in summer. So this is your non-financial data. Now the sale forecast, we have to do the sale forecasting. So the sale forecast is the expected sales of 100 iced coffee per day. Okay, and the price, let's say we have at $4. This is the price each. So if we go for a calculation, let me do it here. So your daily revenue, your daily cost, and your daily profit. So first, you have to write the daily revenue. We have assumed that 100 will be our sale. The prices we set is $4. So what will be the revenue? That will be $400. Now for 100 sale, that the cost will be 1520 that we have obtained from the cost accounting, and the amount will be 120. So definitely the profit will be 400 less 120 will be $280. This is your calculation. Now after doing the calculation, you will move to another step, and that is your budgeting. Okay, so allocate, let's say allocate $500 for marketing. By marketing, what? The new product, the new drink. In the marketing, you will have posters, TV ads, social media ads, and so on, like that, printing media. Clear? After doing this, you will go for the performance metrics. And performance metric, you have to track the sale versus for cost and customer feedback after launching. So this is the management accounting process. Now, after that, after the performing these management accounting process, you will have the second step, and that regard that will be your management accounting output. Management accounting output. Clear? So this output is based on the data that you perform the management accounting process, and this in this management accounting output you will just produce a decision report, and the decision report, and this decision report will be for the owner, of the coffee shop, that whether you are recommending the product to lunch or not. So let's say we are recommending lunching the iced coffee, and we'll mention the reason that why we are recommending, because you don't have to play with the assumption. You have to give the reason that okay, on which ground I am recommending the thing. So first, let's say we say that the projected profit, and that was I think 280 per day, is high. Our first recommendation reason. The second thing is, let's say we say that a customer demand support the new product, and that is your iced coffee. Clear? And the third recommendation, I will say that the marketing cost, we have allocated $500, are justifiable. And why is justifiable? Because of the expected sale. And the last, a budget plan to monitor marketing and production cost. So this is all about the management accounting. Now let me summarize it. This is the process I have explained, but I'll write here the differences, or I will say just say that what is all about the management accounting. So the management accounting is provide financial information to whom? To the manager, and why they are providing this, and what assistant of the management accounting, and that will be the decision. So they will make informed decision. They financial looking both your past data, and it also look about the projection, the future projection considering. Okay, and they also these management accounting information is used only inside, and the reason is this is very sensitive information, because if you want to set the prices at the let's say your price is $5 and your cost is $1, so when the customer know or the public know about this thing, there is a gap between your profit margin is too high, then it will create a bad image. And it includes budgets. We have studied this. It also includes forecasting and the performance report. Okay, hope you have understand this. This is for today. Inshallah, in the next lecture we will discuss about what is bookkeeping, and then the bookkeeping method, single entry bookkeeping, double entry bookkeeping, and then we'll move on to the further study. Thank you.